All right. Okay, cool. I can see these. Where am I today? Very top secret question. I'll address that shortly. Hardik, should we go live? Is it 10:30? Okay, cool. I can see these. Where am I today? Very top secret question. Okay. Good. Whatever you just did, fixed it. I heard me play back, which is really kind of challenging, but it seems like it's working now. We are live. Okay, cool. Friends, how are you? Welcome to the webinar. I just want to welcome everybody and express the following sentiments, which are, I don't mean to minimize the human tragedy or toll, and for those of any of us or any of our friends, loved ones, or family that have suffered as a result of the coronavirus, I want to express, my deepest, sincerest, condolences if there was any tragedies or heartfelt wishes to get healthy. So I don't want to minimize the human suffering and the human toll. In fact, I want to address it head on. But the purpose of this webinar really isn't to discuss the medicine or the science. It's more to discuss the economic implications that we as entrepreneurs and as hosts and as business owners have, because we are in the travel and hospitality business, and it should come as no surprise that travel and hospitality is being curtailed. So that's the basic premise of the webinar. So if you hope to hear things about human tragedy and suffering, it's the wrong webinar. Doesn't mean that I don't have those feelings. It just means that we're focusing on something entirely different. And so with that, I just want to share the following. I was thinking about the coronavirus. I was following the stock market sell-off, as I do constantly. And I had a lot of thoughts about it myself, and opportunities and ideas and suggestions. And I kind of realized, and this is where I have a little bit of a blind spot, that I have a unique perspective on it because I've lived through very similar epidemics, pandemics, flus, viruses in my prior life when I ran a $4 billion hedge fund. And the amount of exposure was significant, right? $4 billion of institutional capital. I have a fiduciary duty to manage that responsibly and navigate through the turmoil and actually find opportunities if and when they existed. So as I was thinking about it myself, I realized that not everybody on the webinar or in the short-term rental space and members of the community at the Short-Term Rental University have the same background and experience and might be feeling a lot of anxiety or concern in and around that. And so that was the basic premise for the webinar, was to just share my prior experience with all of you and my current thoughts about what's going on, not only in the coronavirus itself, but also in the stock market opportunities that may present itself, opportunities to perhaps refinance as interest rates have reached all-time lows. And then also in terms of hosting, what do we do? There was somebody who posted just earlier today in our Facebook group, and we are live on YouTube and via the webinar. So if you are in the webinar or on YouTube and you're unaware of our Facebook group, it's one of the most successful and popular and largest Facebook groups, entirely free. Come join us over there. I think we're going to hit 20,000 members with 6,000 or 7,000 active members every single day and hundreds of posts. So questions like this, the right place to post them is in our Facebook group. And somebody posted just before we went live that they have a request from somebody coming from China and what to do about it. And so that's the purpose of the webinar. I thank you all for taking time on this Saturday. I'm sure you have a lot of other tremendous opportunities with friends, family, and loved ones, and we'll get to, we'll finish this as quickly as possible. We will have some questions and answers towards the end, so please stay tuned. And I'm also going to give you an opportunity to learn more if you're interested in doing so at the end. So please stay tuned, and we'll try and be brief and quick. So the very first thing I want to say is, In investing, dislocation, panic, volatility, all the things that create angst and anxiety and discomfort for many create opportunities for those that can remain calm and stable and not lose their stability. So everything, no matter how uncomfortable it is, can be viewed in a different mindset of opportunity and abundance rather than scarcity and poverty and things like that. And so again, without talking about the human tragedy and toll, what I would say is we're going to analyze this opportunity set for what it is. The first thing I want to share with you all, and again, I'm not a medical scientist, is that as far as flus go, and as far as deaths go, and as far as contagion, pandemics go, this is a nothing as of yet. It really has not escalated anywhere near some of the things that we've seen that have not received any press at all. So for instance, and I'm going to read the CNN headline from 2018. Pardon me while I look at my phone. Here it is. CNN reported on September 27th of 2018, so a year and a half ago, that the flu season in 2018 topped 80,000 deaths alone. So we had 80,000 deaths in flu in 2018, and yet it's not even really a headline. And then at the same time, I have traded through, when I was managing $4 billion, a variety of similar sort of situations. There was the SARS scare in 2003. There was the avian or bird flu in 2006. There's dengue fever in 2006. There was the swine flu in 2009, cholera in 2010, MERS in 2013, Ebola in 2014, measles and rubella in December of 2014, and the Zika virus in 2016. So we're constantly being brought out with these new flus and contagions and fears and pandemics, and they're awful if you're affected. But if you're not affected, they largely don't go very far, although the stock market does tend to sell off due to fear, right? So fear is what causes all this. It's not necessarily the reality, it's just the fear of what would happen. And so the question I ask myself is, well, what about coronavirus makes this so much more fearful that it's really in the press nonstop, and we have all sorts of concerns and so on? And what I would say is the following. China has become an incredibly powerful country. Most of the exports and manufacturing that happens in China affects everyday activities like Apple manufacturers in China. Hardik, I don't know if that's you, but now I'm getting a little bit of feedback. So in any event, China is an incredibly important global power. I don't know, guys. It's hard for me to continue with the feedback. Maybe everybody could hit mute. I don't know who it is. If everybody on the broadcast could hit. Okay, thank you. That's much better. So in any event, part of the reason that this is so concerning, at least as far as the stock market is concerned, is just the importance of China on the global platform, right? I mean, so much manufacturing happens there, so much export happens there, and the rise of the Chinese middle class and high-end class has been incredibly important in terms of spending, right? So they come to America, for instance, and will buy a lot of real estate and diversify their holdings and so on and so forth. And so China is just an incredibly important trade partner. That's why we're at a trade war with them. And so when they suddenly have limited resources, limited capacity to travel, they're on lockdown. We've never seen a country of this magnitude and importance face an epidemic like this. And again, even within China, it's like such a small percentage. It's like less than 1/10,000th of 1% is affected, and fewer of them are passing on or dying. It's really, it's just like a flu. So it affects the people that are elderly or young or sick. But if you're healthy and normal, chances are you'll have a full recovery. And just to assuage anybody's fears, again, if you guys could hit mute, I'd appreciate it. Just to assuage anybody's fears, the virus tends not to be airborne. It tends to be with your hands. So things that we can do and that we are hearing that we should all be doing really small changes by a lot of people will actually contain this. Wash your hands frequently, use hand sanitizer frequently, stop shaking hands with people, even though it's traditional and normal. Now is not the time to do that. So worry less about like breathing stuff. Those masks actually don't do anything. There's holes in the side, so like it can actually get in there, but that's not the way that the virus appears to be transmitted. It appears to be transmitted by contact. So you always wash your hands anyway when you're in public areas, on airplanes and so on. Just wash them more. Use more of the hand sanitizer, put more hand sanitizer in and around your homes, encourage guests staying with you to do that. And if we all do that, then this will be contained and it's not as big a deal. That said, the market isn't reacting like that, right? So why is the market selling off as much as it is? And really, I would say it's the following. In my experience, and I have all the data right here, when we have a fear like the avian flu, the bovine flu, SARS, MERS, Ebola, the stock market always sells off. And then as soon as the fear is contained, it rallies right back. So it's a real V, really sharp V. It's painful on the way down, and then it bounces straight up. So is this a good buying opportunity? And I would say the following: it's to be determined. The reason it's to be determined in this particular case is because we don't know the severity or the length of time that China and its exporting and so on are going to be on lockdown. So you've heard me teach about risk, the importance of risk, understanding risk. And this is a perfect example of what risk is. Risk is the unknown, right? So what you fear is not really risk. That's something that you can address and you can handle. Risk is something that comes out of nowhere that you didn't see coming. You had no idea. Some people call it the black swan. And that's what risk is. And so now that we've identified this risk, we're all trying to react to it. But if you think about my teachings and the numerous videos I've made discussing risk, the single best thing you can do is to diversify your portfolio. So let's just be really specific. There's a region in Italy that is now compromised with the coronavirus. Imagine you were a successful host in that region and you were doing really well and you had 80% occupancy, you were making a lot of money, you were paying off all your mortgages and you grew and you expanded, you had 2 units, 3 units, 5 units, 10 units in this spectacular place in Italy. It's going really well. Now all of a sudden, the risk that you didn't contemplate, that you did not see, happens. Coronavirus happens and the entire community is in lockdown and there's nothing you can do. The bank isn't going to forgive your mortgage. If you're doing rental arbitrage, the landlord's not going to forgive your mortgage. And you now have 10 properties or 6 or whatever the number is in one region, and your business is really screwed. The way to do this in advance and properly, in the way I teach time and time again, even though it's remote hosting and everyone have self-limiting beliefs about why they can't do it, imagine now instead of having 10 in that one little region in Italy, you had 1. And then you had 1 in Germany, and then you had 1 in Spain, and then you had 1 in Norway and Finland and so on. You would be far better off today than if you had all of your eggs in that one basket. But once the risk happens, it's too late to mitigate. You can't get out. You try selling a home, try lowering your price on a rental. Go on Airbnb, lower your price in that region on all 10 of your units to like $1, €1. Nobody's going to stay there. No one's going there. It's on total lockdown. So once the risk emerges, it's too late to address it. So the way that you handle risk on a go-forward basis is you prepare intelligently. You have a diversified portfolio such that any one epidemic or concern or a tidal wave, flood, hurricane, anything like that doesn't wipe out your business. So that's the purpose of diversification, is to survive for another day, because we know the unknown will occur. We just don't know when or in what format, but we're intelligent enough to know that there will be unexpected shocks to the system and we need to be able to survive for another day. And in fact, what we want to do is have enough dry powder, money on the sidelines, savings, so that we can take advantage of the opportunity. And that's what I want to turn to now. So what do I think is happening in the stock market? It's been the fastest correction ever. We've never seen this much of a drawdown this quickly. And the question is why? And I think it's because we've had such a massive run up so quickly. I've filmed videos. You've heard me time and time again saying it's late innings, late cycle. This can't continue forever. Winter is coming. There will be a correction, and we're starting to see it now. And so what ends up happening is the faster the ascent, the faster the decline, because the people that got in at the very end are the first to get out because they can't stand the losses. If you're like me and you're a long, patient shareholder, or Warren Buffett, and I'm not equating us, he's far better than I am, but if you're like Warren Buffett or like me and our basis is really low because we bought long, long time ago and we hold, we're not panicking. We're not running for the doors. We're not exiting. That said, I have been lightening up, and I've filmed videos about that. I said that this can't continue. I've said it on Facebook and other places that I'm lightening up. I don't like the risk return profile at these late stages with the market like blowing off and just going straight up. So I'm a better seller, and I have been lightening up, and I've been taking some profits in that period of time. And I feel really good about that now because those profits are now available for me to re-enter the market. And so I've been dipping my toe very slowly into the stock market. I should just say, in case any lawyers are watching or anything like that, this is not investment advice. I'm not suggesting that you follow in my footsteps. I'm merely detailing how I think and what I've done. If you choose to do similar, that's entirely your choice. But this is the fact. I've been lightening up. Now I've got some positions that I'm redeploying. I've been entering the market selectively. I bought a little bit on Thursday. I meant to buy a little bit Friday on the close, but I was driving up to where I am now, visiting my kids at boarding school, so I actually missed the close. And I will likely continue to buy on Monday because when there is panic and people are rushing for the doors, babies get thrown out with the bathwaters. That's when you can buy dollars for, fractions of dollars. So if I'm paying, say, 75 cents on a dollar, I'd like to buy that. And I encourage people who do follow in those footsteps to have a very long time frame. Do not buy on Monday, expect to make immediate cash return, and then sell on Wednesday if the market continues to go down. If you buy this dislocation, which generally speaking, buying dislocations turn out to be long-term profitable over an extended time frame. So for me, and the way that I explained this to my daughter a couple of days ago, they were talking about it at boarding school. She wanted to know if I was worried about the Dow, if I was worried about the stock market. And as a father, I have to tell you, when my 18-year-old daughter is calling me and asking me about the stock market, I feel like I'm doing my job properly and intelligently and informing her and educating her. So I was really pleased that she reached out to me. And I gave her the following example. If she wanted to buy a sweater and it cost $100, and she went to the store and they just happened to have a flash sale, like she happened to walk in and they said from 10 o'clock until 11 o'clock, everything is 20% off. She doesn't dislike the sweater less. She doesn't not buy the sweater. She actually loves the sweater more. She's getting it at a discount. And if in fact, if it was cheap enough, let's say it was 50% off or buy one, get one free, she might buy two. So if you stop and think about investing just in terms of human psychology, realize that there's a lot of fear. When there's a lot of fear, people do things that are irrational. And if you can remain rational and calm during that period of dislocation, you can have some incredible opportunities that are like gifts. So I want you to think about the opportunity set in front of you, how much exposure you have to stock market equities, both in your normal savings and also in your 401k. And now might be a time to start adding. And the way that I encourage you to add, if you do so, is gradually. So I'm going to make these numbers up. If you have $1,000 to invest, I would not buy $1,000 in one trade. The way that I like to do it is I might buy $250 over 4 trades, over 4 days, or maybe every other day, 4 times. And it doesn't matter if it keeps going down or if it's going up. It's called dollar cost averaging. It's a very great way to get into positions. And I also scale out. You heard me say I was lightening up. I didn't go to cash. I didn't sell everything. I just took some profits off the table and I scale into positions and I also scale out of positions. And I don't worry about the mark-to-market losses. What mark-to-market means is when you take a look at your profit and loss statement at the end of a day, if you have a drawdown or a loss, that is not a realized loss until you sell. So if you don't sell, it's just a paper gain or a paper loss. It's not until you actually have to pay the tax person when you sell that you have that gain or loss. So for me personally, I lightened up on the way up, as I documented on the YouTube channel and in the Facebook group, and anybody who is listening. I'm really glad I did. It gives me some dry powder to actually put to work during this dislocation, and that's what I'm doing. I think that the stock market could be really ugly on Monday, and that's probably an even better time. One of the single best trades I've ever made, and I discussed it in Miami when we did the live event, and I discussed it, I believe, in the Nashville event earlier this year. I lost my job on January 5th of 2009. I was managing a $4 billion hedge fund at the time. I was co-head of investments, running $4 billion for some of the most successful institutions and private investors. And one of the lessons I learned then was you never want to be a co-head of anything during a bad market, because by definition, you don't need you don't need two, you just need one. So we were both let go. And then they did the smart thing and they hired one person, saved a bunch of money, tried to blame the 2008 debacle on us, even though we outperformed the S&P, we outperformed peers. We still had money drawdowns, we had losses. We saw it coming, we tried to get out, we could only get out so much, but we couldn't get out in its entirety. A lot of the things that we traded back then were illiquid. So what did I do? I lost my job in January 5th of 2009. For those of you that follow the stock market, you know that the stock market continued to sell off until March of 2009. And I'll never forget this. I remember thinking, oh my gosh, the world is over. And for a guy who remains calm and rational, the drawdown in March was so epic that people were literally calling for guns and gold. Buy gold and buy guns to protect your gold, because there's going to be world like craziness and nobody's safe. That was the kind of fear that was happening. And I really kind of tried to remain rational. And I remember thinking to myself, if that's what's happening right now, then any savings that I have, any investments that I have are worthless. So I'm just going to buy more. And as it turns out, in retrospect, I literally bought the low. I don't remember the exact date, but March of 2009, I bought the stock market low with my kids' college fund. I have 3 daughters. I bought in each one of their college funds because I was just like, there is no college, there's no money, it doesn't really matter. And we bought the low. And what I would say is that return from 2009, 10 years ago, 11 years ago, it's 2020 right now, has probably paid for, I don't know, 1 year of college for each of them, a very small investment, but the returns have been magnificent when held for a decade. So when there's fear in the streets, if you can remain calm and you can think about this in the long term, some of the best opportunities, and that's probably the single best trade I'll ever make in my entire life in terms of a return. And the reason that it was so good was because the market gave me a gift with the massive dislocation, and I just took advantage of it. So if it gets worse on Monday, I'll continue to scale in slowly, and I'll continue to scale in on Tuesday and on Wednesday, and it's just a methodical buy program. And I would also say, if you're going to sell, do the opposite as things rise. So with that, I'm going to pause here for a second and see if there's any questions here. Is the audio terrible for anyone else? No, I can hear fine. Okay, cool. Let me just take a quick peek here and see if there's any questions. Erica, does anybody have any questions for me, sweetie? Okay. So that's what I think is happening in the stock market. I think there's too much fear. I think that there's oversold conditions, just like there was overbought conditions previously. And therefore, I think that it's a good opportunity if you have some cash on the sidelines and you have a long time horizon and you can reduce that desire to like look at the mark-to-market paper losses and you can look past that. This might be a good entry point for you to start getting involved in more stocks, adding to your exposure, or adding the stocks that you haven't really added before that have direct exposure. I mean, everything is selling off. Anything that has exposure to China is selling off even more, as you would expect. Anything that's in the, say like Disney has theme parks in China. Disney's a great company. I'm not recommending Disney. I happen to own Disney, but I'm just using that as an example. Disney's hurt. Apple is a great company. If you don't own any Apple, it's trading at about $260 today, just down from like $325 a week or two ago. It's on sale. So if you don't have Apple, there's a very strong likelihood that Apple will recover in the very near future and go right back up into the 300s. It might be a really good trade, but it's a better long-term hold. And I'm not suggesting that people trade. Generally speaking, people that don't know how to trade lose money trading, so don't do that. I'm a big advocate of the Warren Buffett methodology: buy and hold. I believe he is, famously known for saying, "What's his holding horizon?" And it's forever. And I try and do that as much as possible too. And then I just trade around the edges to manage my exposure, to manage my income, to manage my, portfolio, and also diversify. It's really important that we continue to diversify.
Question.
Yeah.
For those that are not experienced, what should we look to buy?
Well, I'm a big fan of indices. If you're not experienced, you can buy the S&P 500 stock index. You could buy the triple Qs, which is the NASDAQ 100 index. And you can do that via exchange traded funds or buying the index fund directly. If you buy the index fund directly, I recommend Vanguard. It's a very low expense, high quality mutual fund. But if you don't know what you're doing, stick to the indices, buy the S&P 500 or buy the triple Qs, which is the NASDAQ 100. And that's just a great way to get started. I see a question here from Kim. What kind of opportunities does this offer in real estate? So the opportunities in real estate are lagging. They tend to take longer. Real estate is an illiquid asset class, and therefore it doesn't react nearly as quickly as the stock market. The stock market's extremely liquid. Real estate is illiquid, so it takes a long time. So right now, it doesn't really offer a lot of attractive real estate opportunities in terms of buying property. But the real play in this dislocation from a real estate investor's perspective is the opportunity to refinance. If any of you have been watching the 10-year Treasury, which is what long-term mortgages are underwritten off of, we've seen low yields, highest prices and the lowest yields. For those of you who don't recall, bonds trade inverse. So as prices go up, that means yields are going down. What we care about is the yield, because there's a spread over the risk-free rate is how mortgages are underwritten. So as the risk-free rate goes down, chances are that the spread also starts to come down and or might even expand or collapse. But the point is the overall amount that you can get a refinance mortgage for right now is extremely attractive. So even if you're in the fours, which is like insane. I remember when I started paying attention to interest rates in the 1980s, we had interest rates, risk-free rate in the 17s, 18%. And then I started buying real estate, and the first few deals I did were like the 7%, and I thought it was a great deal. And then I refinanced from 7 to 6, and I thought that was the low, and then 6 to 5, and I thought that was the low. And if you're in the fours now, there's a really strong likelihood that you can take a full point out and refinance in the threes, maybe even as low as 3.25, which is unheard of. I mean, you should have some appetite for a mortgage when you can borrow in the threes. I've made videos about that on YouTube as well, which is basically that there's an optimal amount of leverage that everybody should have in their real estate portfolio. Paying off your mortgage in its entirety and having no mortgage is an inefficient approach to real estate investing. And what I mean by that is if you can borrow money at 3% and make even 6% or 9% doing short-term rentals, then that's a much more optimal solution. So even if you're very risk averse, and somehow I seem to find all sorts of people around me that are incredibly risk averse, there's a prudent amount that you should get comfortable with. If you don't have a mortgage, you might consider taking cash out now. And if you're uncomfortable with mortgage and you hate debt, like my ex, for instance, then do something really modest. Put 50%. So if you have a home that's worth $500,000, take $250,000 cash out and put a 50% loan to value on your mortgage, because that is a more efficient and productive use of your capital. Borrowing low, putting it out to work high, and you make the spread. And if you're more aggressive, you can go up to 60% or 70%. I personally like to hang around between 70 and 80%. I don't go much lower and I don't go much higher. I'm quite comfortable in the 70 to 80%. As I get older and I'm managing a bigger portfolio, I tend to decrease my risk tolerance. So 10, 15 years ago, I was doing as much as 80%. Today, I'm looking at 75 or 70, and some deals I'll look at 60. In fact, I have some properties I own outright, land. It's very hard to get a mortgage on land, but I continue to buy a lot of land, and I don't put any mortgage on that because it's hard to do. So the real estate opportunity, Kim, to answer your question, might be in taking a look at your finances, your mortgage, and doing some financial engineering to take advantage of this opportunity. If the stock market continues to sell off for an extended period of time, I don't mean like for next week, but let's say, and this is a big risk, and this is, I think, what the market is really fearing. Let's just say that China closes down for an extended period of time, not weeks, maybe not even months, but let's just say that it turns off for half a year. That in and of itself could be enough to create the next recession, right? And if that happens, then months after that, real estate prices will come down, and that might be a really good time to buy real estate. But right now, there's not much of a reaction. It's very muted. It's a slow-moving asset class. It's illiquid. So the best way to play the opportunity set is to refinance, whether it's cash out or lower your rate. And just a heuristic or a rule of thumb, if you can take a full point out of your mortgage, it's probably worth refinancing. So what does that mean? If you're at 5 and you can refinance and you get it for 4, it probably makes sense to refinance, pay the fees, and save a point. I would not refinance for an 1/8 of a point savings or a 1/4 of a point savings. I would refinance starting at about 75 basis points to a full point. That's when it starts to make sense. And if you can do it for more than a full point, then you must do it, right? Just because you're leaving money on the table.
Is it too early to buy now? Are we in oversold condition?
In the stock market, it is not too early to buy. We are in an oversold condition, just like we were in an overbought condition. But here's the funny thing about the stock market, and it's a very famous quote. The stock market can remain irrational for longer than you can remain solvent. So what does that mean? All of this stuff that we're discussing right here is based on human psychology. So human psychology and fear can last far longer than the reality. And therefore, very smart people that have been incredibly successful, centimillionaires, billionaires, people that really know what they're doing, have lost money because they were wrong on the timing. They were ultimately right in their conviction, whether it was to buy or to sell, but the timing component is really important. And so therefore, they couldn't remain solvent or in the trade long enough. The pain got too great. And that's why I suggest that people scale in. If you divide your purchase price into 4 purchases or 5 or 10 or whatever your comfort level is, chances are you'll be able to weather any storm as you build your position and accumulate. Never try and pick the bottom. I got very fortunate that I bought the March 2009 bottom, but then I thought I was like just throwing money away. I did not think I was buying the bottom. I just thought, my gosh, here's a Hail Mary pass. I have no idea what's going to happen. I've never seen anything like this in the world, but I had the strength and conviction and the clarity of mind to just throw the pass anyway. And then it was a touchdown. So thank goodness for that. It paid for probably 1 year of college for each of my kids. And as they get to be college level, it's fantastic, right? It's going to be amazing that actually transpired. Any other questions here, sweetie?
What do you recommend we do as hosts, if anything, with bookings from China, South Korea, and other countries significantly impacted by the coronavirus?
Yeah, so the question is, what do we do as hosts when guests from these areas want to come visit? And that's a very personal decision. My gut tells me that you're going to get cancellations anyway. I think there's going to be additional quarantines. And so if you need the money and that's the booking that the only booking you can accept, then that's a personal decision. Again, it's really touch-based. So if somebody comes and stays in your home and that's a personal decision, many of you are not going to do it. Personally, I don't need the income that much, so I'm not going to do it. But if it was like, you have to take the income to make the mortgage or you're going to lose money, would I take it? Yes, I wouldn't lose it. I wouldn't be that fearful. All I would do is completely scrub the place with disinfectant after they check out, right? I'd leave hand sanitizers there and I would have the cleaning team go in and like wear gloves and then just sanitize the thing entirely. And that is likely enough. Again, please proceed with caution. Please proceed with your own risk tolerance in mind. Please understand your own thresholds. I'm just sharing with you an idea not an instruction manual.
Do you feel this virus is going to affect STRs in the USA for the ongoing future, even into summer?
I don't believe that this is going to affect anything for the extended period of time. Again, I've seen, as I mentioned earlier in the broadcast, 5, 10 different pandemics, flus, viruses, and in every single instance, modern science is able to contain it quickly. I think that we're already looking at some potential companies. That's a company, I think it's called Moderna, Moderna. They're working on a whatever vaccine for this, or a solution, medically speaking. It could take as much as a year, but I think between quarantine and proper, cleaning and so on, this will likely be contained. The number of cases is really small. The number of cases of what are called community contagion is really small. And community contagion means where people don't have specific contact with known areas with the contagion. So if you travel to China, or you hung out with somebody who was in China and then you were to get the virus, that's not the community contagion where pandemics really are feared, because you can isolate those cases, you can keep people in quarantine, and so you can limit that exposure, right? That's why those cruise ships that had a lot of people that were sick were kept separate and apart. They weren't able to come in and just disembark and go on with their life. But the community is where it gets really scary. And there's now 2 cases in the United States. One's in California, one's in Oregon. And these are people that have no known contact with anybody who's traveled to China or Italy or wherever else the virus is, and yet they themselves have the virus. So hello? Hello?
He's back.
Okay, can you see me? Sweetie?
Yes, he can see
Okay,
you.
cool. Sorry about that, guys. So basically, that's the fear, is this contagion in the community area, but I think that that'll be contained. And I don't believe that this is going to be a concern for the summer months, although, I'm just one man with one opinion. I can't tell you with certainty. I do believe that some of the international travelers that might be coming to our destinations here domestically in the US may change their travel habits. And so we may not have as many international visitors this summer if this continues. If it gets contained, I think everything will be fine. And so some of the areas that I have investments in, like in Jackson Hole, Wyoming, which are near Yellowstone National Park, some of the tourism may be down from abroad, but there's still plenty of domestic tourism. And so I'm personally not concerned at this time. I had a way to check the chats. Oh, there we go. Cool. Great. Any other questions here?
Don't you think there's a big risk that when people start to die in the US from corona, that we are going to see even more panic and a bigger fall in the market?
No, I don't anticipate that we're going to continue to see sell-offs of this magnitude in the market. There's an incredible amount of cash sitting on the sidelines by some very smart investors that have a lot of experience, and they are looking to enter. They're starting to scale in right now. And one of the things about the stock market is that it's a forward indicator, right? Like, we discount the future now in real time. And so the reason that the market is selling off has nothing to do with the few numbers that are reported both in the US and abroad of deaths and the disease. The reason the stock market is selling off now is in advance of those numbers actually getting worse. So when they in fact do get worse, there's a very strong likelihood that they will be worse, less bad than anticipated, and the market will rally. That's one of the funny things about the stock market. We've heard it before, and I will just repeat it here. You buy the rumor, you sell the news. So how does that apply to this? Right now, we're selling the rumor. The rumor is that it's going to get worse. So everybody's selling, everybody's running out the door at the same exact time. But when the reality gets reported, that's when you're going to want to buy because, or in advance of that, because it's going to go straight up. So unless things get really, really out of control, I think that this is a interesting time to start adding. As I indicated, that's what I'm doing personally. And if you hold long enough, you will be fine, right? Like if you have a long-term time horizon, like I did in March of 2009, I knew my kids were going to college in 10, 12 years. So I was like, I can buy this now. It can be worthless for a long period of time, but my bet is in 10 years from now, 12 years from now, it'll be worth more. And it's been worth multiple times, multiple times. Um, so that's what's going on there. Let me just see here. Go ahead.
What about buying land and holding to build? Or is the STR opportunity cost too high? So you should build regardless.
Yeah, so the question that Erica just read to me relates to purchasing land and just holding it. Land is a very speculative investment and it has a lot of risk in it. And that's why you can't get mortgages. Even though the land and the dirt has value, it's really hard to extract that value and it's very cyclical. It goes in all sorts of counterintuitive ways. So buying land for the average person is not something that I recommend. And to your point, you are correct. The income opportunity right now in the short-term rental space is so great that if you can purchase a short-term rental and put it live, you should. If you buy land and you can develop and build on it, then you should, because there's a lot of income that you are leaving on the table by just holding land. It is unlikely that the land will appreciate faster or greater than the income that a short-term rental will generate today.
If Powell cuts rates is this really going to help stall a market collapse? If people are quarantined and cannot work, nothing will stop the Dow going below 15,000. Supply chains are already breaking.
Yeah, so the question, and it's a really good one, is about the Federal Reserve and easing. And will that do anything to stem the losses in the stock market if everybody is quarantined and must work from home and so on? And the writer suspects that the Dow will be halved or near that to about 15,000. And what I would say is you don't fight the Fed. That's basically another Wall Street maxim. You don't fight the Fed. If the Fed wants to lower and ease, and they've already indicated that they may, and they would likely do it in global coordination, kind of like we saw in 2009. If the entire world continues to ease, that will provide enough certainty and comfort and provide confidence for investors to deploy capital, because capital is practically being given away. And also the Fed is here with our backs. Now, the problem with that is we've lowered interest rates so much that we don't have very many more quivers. You know, I think the federal funds rate in the United States is at about 1.75 or 1.5. And so that means if they were to lower 6 times, a quarter point each time, they'd be at 0. So they don't have that many in their quiver anymore. They've already deployed a lot of them. But if they were to start to ease, and the markets, the Fed funds futures market is now 100% predicting 2 eases. I saw yesterday, I think it's 65 or 70% for 3 eases, and then like 50% of a 4th. So the bond market is who you want to follow in these dislocations. The bond market is much bigger than the stock market. And generally speaking, the people that trade fixed income products like bonds with quantitative techniques and math behind them are the people that are smartest and forward thinking, and the stock market tends to follow and react to the bond market. So what you want to look at is the bond market and then trade the stock market off of that. So to your point, I don't think that we're going to get halved. And if you're scaling in, set your parameters such that you take advantage of that fear that you have and say, I'm going to buy today and then I'll buy in 30 days. If I buy every day, you could buy every 30 days. Someone else could buy once a week. So the way that you enter the position can have something to do with your risk tolerance and your conviction. right? So there's no right way of doing it. It's very personal. But if your belief is that we're going to 15,000, I wouldn't wait to get to 15,000 and then try and buy. Chances are by then you'll be so freaked out you'll think we're going to 7,000. I would start buying now and then slowly scale in. Every time we drop, 2,000 points, we're at 25,000 buy, 23,000 buy, 21,000 buy, 19,000 buy, until you get to 15. You'll be really happy you did that.
Do you abide by a 25% trailing stop?
I've never actually used a trailing stop before. And for those of you who don't know what that is, that's a purchase where you say, if the market goes down, in this particular case, the person said 25%, I want to sell. And generally speaking, the way you do that is by, the reason that you do that is to protect your gains. That's generally when people put trailing stops. You could also put in a trailing stop to limit your losses. But in my experience, whatever number you figure, we're going to hit that number, you're going to get stopped out, and then that's the bottom when we rebound. I personally like to keep my head in the game and analyze things in real time and try as much as possible. One of the best things any trader can do, and again, I'm not encouraging you to be traders, I'm encouraging you to be buy and holders, but one of the most important lessons that I've ever learned in trading is to sit on your hands and do nothing, right? If you start to try and get smart and cute and time things and think that you know what you're doing, chances are you're being inefficient, ineffective, you're leaving money on the table, and you would have been better off, and there's multiple studies that support this, doing absolutely nothing, buy and hold.
What is your feeling regarding real estate in the November, excuse me, what is your feeling regarding real estate after the November election?
So real estate in many markets has been sort of on hold while we wait to find out what happens in the election. And obviously, I don't know what happens in the election here in the US, and a lot depends on who is elected. But the stock market generally dislikes uncertainty, and the real estate market dislikes uncertainty. People like clarity. People like to know what it is that they're doing. And so when there's an election year, it's really hard for people to have that clarity. And so a lot of people just sort of wait until they have clarity. So there's maybe less opportunities to buy and sell. And then once we know what happens, depending on what happens, it might be a really interesting time to buy or sell. Let's have another live event once we're, or another webinar once we have that clarity.
Which is best, to develop your personal credit history or your LLC, provided that you are planning to purchase real estate under LLC?
Cool, great question. So what is better, to purchase the property in your personal name or with the LLC? The fact of the matter is you should use LLC for your liability protection, so that if you have a lawsuit or something, it's just limited to that one location. And then the second thing I would tell you is, even if you have an LLC, they are likely going to ask you to personally guarantee, and you will be using your own personal credit to purchase it anyway.
Why is gold EFT or gold prices going down? Seems like it should go up.
Yeah, so gold is actually a flight to quality. And so historically speaking, you would see gold rally in market dislocations like this, just like you're seeing the risk-free 10-year and bonds and notes increase in price and decrease in yield. So it's a phenomenon called the flight to quality. And what I would say is I'm unsure exactly. I'm not a gold bug. I've never really traded gold particularly. I don't find a lot of value in it. It doesn't pay any dividends. It doesn't have any income. So it's just a store of wealth. And I would say right now, even stores of wealth can have uncertainty. And also it's a hard product to like trade and take physical delivery of. A better question for me is, why is cryptocurrency selling off? Because it's supposed to be the digital equivalent of gold, and it's supposed to have flight to quality type characteristics as well, and it too is trading off. And so what this all tells me is that there's a massive reduction in risk. People just want cash. People want to get out of gold. People want to get out of crypto. People want to get out of any stocks. People aren't selling real estate yet, or maybe they've listed it, but it's not available for sale. It hasn't transacted. But basically, it's a big risk off trade right now. And in the face of that wave of risk off, there's massive opportunity. You're not going to get rich quick immediately. You might have to sit on your hands. You may have to hold for a while. But when assets get thrown out and there's no valuation concern, generally speaking, that is the time that you want to consider entering.
On booking prices, would you lower prices or hold out with normal pricing you had in the past year?
Again, so the question is about how do we handle this as short-term rental hosts? Should we be lowering our pricing for our lodging? And this is a very personal question based on your financial situation. If you need the income and you need that certainty, go ahead and lower prices. There's another Wall Street adage, you never go broke taking profits, right? Think about that. You never go broke taking profits. It's the same thing here with the real estate and the short-term rental market. You will never go broke having people staying in your home. You may be less profitable. You may be even have losses, but you'll have less losses. So it's based on your risk tolerance and how much you need that income. If you need the income, lower your prices. If you don't need the income, I would keep prices steady and continue to adjust them, intelligently. I monitor our prices every single day on every single one of our properties. We use dynamic pricing. I'm a big fan of beyond pricing. And so we monitor the supply and the demand on a daily basis, and we adjust our prices on a daily basis. But what we are not doing is just discounting massively. We didn't go from $500 a night to $400. We're following whatever the dynamic pricing models tell us to do. And so we might be increasing gradually or decreasing gradually, but it generally tends to be very gradual. In my personal portfolio of short-term rentals, I increase or decrease prices by like $3 or $5 at a time, not by tens and certainly not by hundreds.
Any quick thoughts on crypto?
Yes, I remain bullish on crypto, in particular Bitcoin, and that's a buy and hold asset for me. I don't day trade it, and I think that there's a lot of opportunity on a go forward basis. There's a halving coming up, and you start to see things like J.P. Morgan Chase. Jamie Dimon, the CEO of J.P. Morgan Chase, was on the record, I think about 2 years ago, saying that they would never trade crypto and that had no meaning and it was worthless and so on and so forth. And now the exact same bank earlier, I think it was about a week or two ago, came out and said that Bitcoin is the foundation for future blockchain and is an incredibly important part in the early days of digital monetization. So people that said one thing a couple of years ago, starting to change their tune. I think it becomes an incredibly important asset class, and I personally am long. And in the way of crypto, I hodl, which is a funny way of saying hold. It was a typo. Some guy was, screaming and saying hold. He mistyped it. He said hodl. So for crypto enthusiasts, I hodl.
We're caught up on questions.
Okay, cool. So those are the questions. What I want to just share with you is a couple of more thoughts. I encourage people to relax. I encourage people to stay calm. I encourage everybody to wash your hands and minimize hand contact. And then with your hands, definitely don't put them near your nose and mouth. Like just keep everything clean and safe. Put sanitizers in your different properties so that the guests can wash their hands and your cleaning teams can wash their hands, and just really take sanitization to the next level. We should be doing it anyway, but it's more important today than ever before. And I think in the not so distant future, there's a very strong chance that we'll look back on this broadcast and say, a lot of the things that I said about buying and scaling in and the short-term nature of the dislocation will be proven correct. I've seen it time and time again. Doesn't mean that this time isn't different. It's just to say that I have a lot of experience with this, and I'm not panicking. In fact, I'm trying to take advantage of it. So that's the first thing I would say. The second thing I would say is please come join us in our Facebook group. Like I said earlier, there's 20,000 hosts from all over the world who are seeing and doing things differently and intelligently and may have more experience with people or infected regions. So come hang out in the Facebook group. And then the third thing that I would say is, we're all hosts. We're all doing our absolute best. This is an emerging asset class, which means that there's a ton of opportunity. And the worst thing that people could do, in my personal opinion, is give up or quit or say, I don't want to do this anymore. This is too much headache. It's during these periods of time now, but we'll see a washout. But the strong get stronger, the weak get weaker, they fold. You've heard me in videos time and time again talk about the pendulum swinging too far. This is an opportunity for the weak to get washed out and for the strong to stay. We will see less hosts and therefore less competition from people that just really didn't know what they were doing, or they were not thinking about risk and they got way over levered, they grew way too quickly, and they can't weather on a storm like this. Which leads me to what I've been teaching time and time again about the importance of diversification. If you are a well-diversified entrepreneur and you have opportunities and homes or condos or whatever in a variety of places, you will be fine. The people that are going to be hurt are the people that are at the epicenter of this, whether it's in Italy or in South Korea or in China. If you had all your eggs in one basket, this risk will hurt. So I encourage you to diversify. If you're not diversified now, start to think about it. If you're thinking about growing and scaling, please don't do it in the same exact location where you have something else. This is an opportunity to become educated and learn how to do remote hosting and start to spread the risk intelligently, which I've been promoting long before this dislocation, this black swan, this risk occurred, right? So, and start to think about risk proactively. You start to think about risk early, before other people. You take opportunity that other people don't see, and that's how you generate higher returns and you differentiate yourself. So this just sort of reinforces all of the lessons that I've been teaching. Now I can sort of say, aha, this is why we do it. And if it continues to get worse, you'll see the people that survive this are going to have well-diversified portfolios, because not every region is going to be hit the exact same way. And if you want to learn more on how to do this and where to select properties and how to diversify and all of that, I want to share with all of you a very special offer. My team has been working on putting this out. It's going to come out in, I don't know, the next couple of weeks or months, but we are releasing the full 2-day recording of Nashville Live. We had 36 entrepreneurs in August of 2019 for my first ever live event, where I went through how to identify cash engines, how to diversify, how to do remote hosting, and how to grow your business intelligently. Charles has done a wonderful job editing it. It's 16 hours of recorded video. It includes all of the different slides and the workbook and everything else that we did in Nashville Live. So if you wanted to come, but you couldn't come, if you're new to the channel and you had no idea that this was even happening, but if you want to catch up and watch 16 hours of what Charles has called the best content that we have ever produced, we want to share that with you. And we're going to be introducing it to everybody in the next few weeks or months at a price of $2,000. But for anybody who's attending and listening to this webinar, I want to encourage you. Hardik sent me the code. I have to look it up. Give me 1 second. I want to encourage you to go to the link that Hardik will post, and we'll give you 50% off today. So you can have 16 hours of the best content that we've ever produced, hand-holding, educational, how to think about risk, how to diversify, how to find these cash engines, what tools and techniques can be used so that you can diversify yourself and avoid this sort of thing by going to the page now. And I think it's a 24-hour offer. We're not really looking to sell this yet. We're going to introduce it in the future. But based on what's going on right now, the people that are paying attention to this, I want you to take advantage of this offer and start to diversify and start to educate yourself beyond the 36 people that were in Nashville. So it's 16 hours of content. And the way to check out is str.university/50, that's the number 50 off. So str.university/50 off. And you can get the full 16 hours for $997 for the next 24 hours. I encourage you to take advantage of it. It's well worth every single penny. If you don't make 10 or 100 times that money back, then there's a problem. It's really the best content we've ever produced, hand-holding you, walking you through exactly how to think about all this and what to do. So I'm incredibly grateful for Charles putting that together and the team putting this offer together and helping you. Yeah, can you repeat the address and code? Nashville was awesome. $1,000 is an amazing deal. So Kathy was there. She was in Nashville and Miami and paid $3,000 to attend, plus the cost of flights and hotels and lodging and all that. So thank you, Kathy. I really appreciate that. It was amazing. I had a great time with it. And now we're releasing the videos, so you won't be there in person. You won't have the community. You won't have the opportunity to ask the questions necessarily, but you will have all of the content that was delivered in super high quality. I think it's 4K audio and video, and all of the slides and everything else, so you can do it on your own pace. You can learn at your own pace and keep refreshing over time. $1,000 is really a steal. Oh, Hardik just posted the link. Thank you, Hardik.
You ready for
Paula,
some
valuable
questions?
content. Yeah, a couple more questions, and then we actually have to go. We're,
Okay. This is actually from Anthony. Are you seeing more cancellations in the US as a result of how you would recommend handling this? Excuse me. Are you seeing more cancellations in the US as a result, and how would you recommend handling this? So again, just maintain your
yeah,
cancellation policy,
yeah.
flex it, etc.
Yeah. So here's what I would say. I have yet to see any cancellations on any of my properties, but I'm a very small subset, right? I only have whatever, a couple of dozen that I'm exposed to. So I have yet to see more cancellations, but if this does get worse, there will be more cancellations. And as far as maintaining your superhost status and not canceling and so on and so forth, I predict if this does in fact get worse, Anthony, Airbnb will do something to modify their policy, because they're not looking to damage super hosts that are just trying to protect themselves and their family. So my guess is, if this in fact gets worse, just like the Federal Reserve is easing and trying to support the economy, the global economy, I think Airbnb will or should step out and support and promote the hosts and our families and our best interests as well.
Do you believe we are heading toward negative interest rates, or rates so low real estate could appreciate in down equities market?
Yes.
Just saw the 10-year treasury breakdown in a major way.
Yeah. Is there somebody's name on that? No?
No.
Okay, so somebody just asked a very intelligent question, which is about going to negative interest rates and whether real estate will appreciate in that environment, even in the face of a declining stock market. And the answer, I believe, is yes. I've taught before. Ray Dalio from Bridgewater believes we're in a new economy where we're in global, very low or flat or zero, even negative interest rates. And we're starting to see that. We have negative interest rates in Germany. We have had negative interest rates in Japan. The US is at all-time lows in the 10-year. We touched 1.15%, which is insane to hold a 10-year note. So I do believe we are in a new era. I do believe interest rates will stay low for an extended period of time. And I do believe that all assets will inflate, including real estate. And that inflation, right, as real estate and other assets, as money gets cheaper, people borrow cheap and put that money to work by buying assets, just like I described earlier in the broadcast. What that generally leads to is inflation. So at some point we will have inflation. Real estate assets should inflate. And that's sort of a good news, bad news story. We don't want too much inflation. So we have to keep an eye on it. But we're not seeing any inflation now, and we are seeing global interest rate declines, near negative in certain areas. And I think we continue to see that. I don't know if this pandemic gets contained, that the 10 years fair value is at 1.20 or wherever it is right now. I think it'll likely decrease in price and increase in yield to a more realistic level. But that's based on things normalizing relatively soon.
Do you think the bounce off this correction is going to inflate the bubble even more, with Fed expected to 75% chance of 0.5
Basically, yeah.
cut in March, China pumping money, low negative rates?
Yeah, this is the concern. As the Fed continues to ease and money gets cheaper and we're doing quantitative easing, it leads to asset price inflation and overall inflation, and it's not a healthy thing. So for those of you who remember Helicopter Ben Bernanke, that was basically what people were concerned about. You're putting way too much liquidity into the market. Quantitative easing has an ugly side. It has yet to rear its head, but generally speaking, it does. I don't know that it does it in 2020. Maybe it's in 2022, or maybe 2025, or maybe 2030. But there is always a reversion to the mean, and the pendulum swings too far. I said earlier in the conversation that when I remember starting to pay attention to interest rates in the 1980s, the risk-free rate was 17, 18%, which seems impossible now. But it seems equally impossible to me that the 10 years trading at 1.15 or 1.2. So the real value at some point in the future, the normalization rate is probably higher than here in terms of yield, lower in price, higher in yield.
Let's see. Would you scale in to buy S&P 500 right now?
Yes, I covered this earlier. I would personally be scaling in to buy the S&P 500 or the triple Qs, which is the NASDAQ 100. I would just do it slowly, gradually, methodically, blindly. Just set your buy program and stop looking at it. Put it away and come talk to me in 10 years. You'll be very happy.
Under interest rate conditions, is ARM or fixed rate mortgage best strategy?
So that's a very personal preference, and one that I'm wrestling with right now with some of my analysts as I continue to go out there and buy short-term rentals. Erica and I are leaving the East Coast, and we're going to travel for the next couple of weeks and months, buying things due to my 1031 exchange. And it's a very personal decision. You know, if you are of the belief that the interest rate environment is going to stay low for an extended period of time, then you should do an ARM. You know, take the risk that it changes 5 years out or 7 years out. And I've been drawn to that of late. And the reason I've been drawn to that of late is that we are in a declining interest rate environment. And so I continually seem to be rolling down at lower and lower interest rates. And my fear that interest rates are going to spike has yet to materialize. I'm cognizant that it will materialize at some point in the future. I just don't know when. So it depends on your risk tolerance and also sort of like lining up your asset to your liability. If you know you're going to own a home for the next 30 years, maybe it's your primary home, then lock in a 30-year fix at this 3.25% interest rate and just never look back. But if it's a short-term rental and it's a remote one and you don't know what you're doing or for how long, then don't necessarily overpay by doing a 30-year fixed, because the yield is going to be higher. Your monthly payments are going to be higher. So you're basically paying for that certainty. And if you yourself are uncertain how long you're going to hold it, then don't pay for the certainty. Try and align your hold period with the duration. If you think you're going to hold this one for 5 years or 10 years, then get a 5-year or a 10-year ARM, match your assets with your liability. And that's one of the biggest reasons that I dislike rental arbitrage, is because there's a mismatch of duration. And I've seen more super intelligent people blow up when they're financing short-term, using short-term interest rates to finance long-term debt. And what ends up happening is there's a dislocation on the front end. This gets out of whack, and all of a sudden they're upside down, and the duration is what kills them, especially when leveraged. Okay, so friends, I hope you found this helpful. Again, if you want to learn more and you want to learn how to do this and you were unable to attend us in Nashville, go ahead and click on the link that Hardik put here, www.struniversity/50, that's 50 off. And I believe for the next 24 hours, instead of paying $2,000 for the best content we've ever made, 16 full hours of high definition video, excellent audio, wonderful editing, and all of the different slides. And it's going to be like you were virtually with us in Nashville. The attendees that came to Nashville, they spent $3,000 plus hotels and airfare and all of this. Many of them returned to Miami. Many of them have grown their business significantly since spending time with us. I think we have some testimonials in people and how much faster they've grown, how much clarity they have, how much more conviction they have, and how much it's changed their lives, which was the goal. The reason we had 36 people there was because I wanted to change lives. It's such valuable content. We want to release it to everybody. We're going to do it in the near future at $2,000 for the 16 hours, which is still only about $100 an hour. It's a remarkable deal. But everybody wants a discount, and I want everybody who's paying attention to this right now to get the best deal ever. You won't see this again. You got 24 hours. So if you want to grow, you want to learn, you found this educational, you think that I've got insight that you could benefit from, buy the 16 hours, watch an hour a day for the next 16 days, and you will grow tremendously. It's a $999 investment in yourself. Nashville was worth every penny. Amazing. Thank you, thank you, thank you. Thank you, Mercedes from Alaska. Friends, we're about to get kicked out of this really nice hotel room. Eric and I are going to get in the car. We're going to go visit my sister in Vermont. We've got a 3-hour drive. And then tomorrow, after we wake up, we're coming right back here, 3 hours back, so I can see my kids for lunch. And then we have an afternoon flight to, well, I'm not going to disclose the place, but I'm going shopping. Buying time. All right, friends, have a great day. I really appreciate your time. And please, I encourage you, go ahead and take advantage of the 50% offer. You want a dislocation, you want an opportunity, you want to make a smart buy now or pay 2x in the future. Arrivederci, ciao. Thank you so much. Stay safe, wash your hands, don't touch your face, and limit hand-to-hand contact with everybody, even if they're loved ones. Just don't shake hands. wash your hands, be safe. Bye, everyone. Thank you.